Ladies and gentlemen, we are now 36 hours away from the most significant financial fracture in precious metals history. My name is Marcus Blackwood, known to many as the Vault Breaker, and what I am about to share with you is not speculation. This is not theory. This is mathematical inevitability unfolding in real time as we speak on this 7th day of January 2026. Right now, at this very moment, the global silver market has split into two completely separate realities. Think of it as a bridge that is cracked down the middle. On one side, you have the digital world, the screens, the tickers, the exchanges in New York displaying a price that exists only in computer memory. On the other side, you have the physical world, the vaults, the refineries, the trucks carrying metal across borders. And these two worlds no longer agree on what silver is worth. This is not a disagreement of opinion. This is not a debate between bulls and bears. This is a mathematical divorce between paper promises and physical reality. The price you see flashing on your screen, the number that CNBC shows you, the figure that Bloomberg reports, that price is now a museum artifact. It is a number from a world that no longer exists. The real price, the price that matters, the price you will pay if you actually want a whole metal in your hand, is completely different. Let me say this in 3 different ways so there is absolutely no confusion. First, there is no longer a single price for silver. Second, the market has bifurcated into fantasy and reality. Third, if you're watching the paper price thinking you understand what silver costs, you're staring at a mirage while the real caravan has already left the oasis. Bank of America, one of the largest financial institutions on planet Earth, an institution that spent years, decades even, telling investors to avoid silver, to ignore silver, to treat silver as a speculative waste, has just issued a price target of $309 per ounce. $309. Not 30, not 40, $309. This is not a typo. This is not a junior analyst getting overly excited. This is institutional capitulation. This is a white flag from the banking complex. But here is what makes this situation far more urgent than a simple price prediction. While Bank of America talks about $309 as some distant target, the physical market is already sprinting toward that number right now. Physical dealers in Tokyo are quoting $130 per ounce for immediate delivery. Dubai markets are trading at premiums of 80% over the paper spot price. Shanghai, the largest physical silver exchange on Earth, has seen its inventories collapse by 43% in just 14 days. We are watching the final countdown. The bridge is not cracking anymore. The bridge is falling. And you have less than 36 hours before the two sides of this market can never reconnect. What I'm going to show you in this video is 3 distinct price levels that now exist simultaneously, the mathematical proof that arbitrage has died, the vault drainage that cannot be stopped, and the secret Federal Reserve bailout that is happening behind closed doors while you sleep. Let me take you through 3 separate markets, 3 separate prices, 3 separate realities that somehow all claim to be trading the same metal. The Shanghai Futures Exchange closed its most recent session with silver trading at $84.55 per ounce. 84.55. Write that number down. Memorize it. This is not some obscure regional premium. This is the largest physical silver exchange on planet Earth, setting a price that is fundamentally disconnected from the West. Who is buying at $84? Not speculators. Not retail traders gambling on price charts. The buyers at this level are Chinese battery manufacturers who understand that without silver, their factories stop. These are solar panel conglomerates who know that the new Topcan technology requires 50% more silver than old panels. These are state-backed entities who have received intelligence, insider intelligence, about export restrictions that will make acquiring foreign silver mathematically impossible starting January 9th. This is the price of the real world. Let me say that again differently. This is what silver costs when your alternative is shutting down a $10 billion factory. This is what you pay when not buying means bankruptcy. This is the panic price, the price paid by those who have run out of time and run out of options. In Dubai, in London, In the secondary markets where dealers actually handle real metal, where trucks deliver actual bars, where you can walk into a vault and point at a stack, the price is $79.61 per ounce. 79.61. This is lower than Shanghai, yes, but it is still massively elevated above what your screen tells you. This is the honest physical market. This is the price set by supply and demand without government interference, without exchange manipulation, without the leverage games played by paper traders. A dealer in Dubai has metal. You want metal? He quotes 79.61. You can argue. You can negotiate. But if you want that bar loaded into your vault today, right now, this instant, you will pay something very close to $79. Notice the premium over New York. Notice that even in the relatively calm physical markets, even where there's not yet full panic, even where some inventory still exists, the price is already 10% higher than the paper market claims silver is worth. Now we come to the COMEX in New York, the commodity exchange, the place where silver has been priced for generations, the place where banks set their hedges, where funds take their positions, where the so-called spot price is determined. And what does COMEX say silver costs? $72.15. 72.15. Let's do the mathematics together. Let us calculate the spread, because this number is the smoking gun that proves the entire pricing system has collapsed. Take the Shanghai price of $84.55. Subtract the COMEX price of $72.15. The difference is $12.40 per ounce. 12.40. Now convert that to a percentage. Take 12.40, divide by 72.15, multiply by 100. The answer is 17.2%. The physical market in Shanghai is trading a 17.2% premium over the paper market in New York. 17%. Not 1%. Not 2%. 17. In any functioning market, in any rational system, this spread would exist for approximately 8 seconds before arbitrage traders destroyed it. Here is how arbitrage is supposed to work. You see silver trading at $72 in New York. You see silver trading at $84 in Shanghai. You buy in New York. You sell in Shanghai. You pocket $12 per ounce. Risk-free. Guaranteed. This is free money sitting on the table. So why is no one picking it up? Why has this 17% spread existed not for 8 seconds, but for 8 days and growing wider every single day? Because arbitrage is dead. The bridge is burned. Let me explain why in painful detail. To arbitrage this spread, you would need to buy silver on COMEX, take physical delivery, load it onto a ship, transport it to Shanghai, and sell into the Chinese market. But here's the problem. China implemented strict export licensing requirements on January 1st, 2026. They have essentially ring-fenced 65% of global refined silver supply for domestic use only. That metal can enter China, but it can never leave. So you cannot arbitrage this spread because the arbitrage requires moving metal from west to east, but the east has built a wall. The metal flows one direction. It flows into China, into Chinese vaults, into Chinese factories. And once it crosses that border, it is gone forever from the Western market. It will never flow back. The arbitrage is not unprofitable. The arbitrage is impossible. This is why I keep saying the bridge is burned. New York has become an island of paper promises floating in a digital sea while the physical world has sailed away to other ports. The COMEX price of $72 is not wrong because traders are stupid. It is wrong because it is measuring something that no longer exists. It is measuring the price of a promise to deliver silver at some future date. But the market no longer believes those promises can be kept. Let me say this 3 different ways so the enormity sinks in. The bridge connecting paper silver to physical silver has been destroyed. The arbitrage mechanism that kept prices synchronized across global markets has been killed. New York is now trading a derivative of silver, a financial abstraction of silver, while Shanghai is trading actual metal that actually exists in actual vaults. And here is the terrifying part for anyone still holding paper contracts, thinking they are protected. If you cannot arbitrage between these two markets, if you cannot force price convergence by moving physical metal, then there is no mechanism left to anchor the paper price to reality. The COMEX price could theoretically drop to $50 while physical trades at 100. Or the COMEX could gap up to 100 trying to chase physical. But they will never touch. They will never reconverge. Because the bridge is ash. Now let me take you inside the COMEX delivery system, because what happened in the last 48 hours is the single most important data point in this entire crisis. Yesterday, I told you about the delivery notices from the previous session. I told you that 69 contracts have been stood for delivery. 69 contracts at 5,000 ounces per contract. That equals 345,000 ounces. That is 345,000 ounces. Many of you laughed. Many of you said this proves the silver market is dead, that nobody wants physical, that the squeeze narrative is fantasy. 69 contracts? That is nothing. That is a joke. That is proof that COMEX is functioning normally and all the panic is overblown speculation. Well, let me share with you what happened today. Let me share the number that came across the wire at 9:30 this morning New York time. 1,847 delivery notices. 1,847. Not 69. 1,847 contracts stood for delivery in a single session. Let us do the mathematics step by step, because this number is so staggering that you need to see the calculation to believe it. 1,847 contracts. Multiply by 5,000 ounces per contract. That equals 9,235,000 ounces. 9.235 million ounces. Let me say that again. 9.2 million ounces of silver were demanded for physical delivery in one trading session. Now let us compare. Yesterday, 345,000 ounces. Today, 9,200,000 ounces. Take 9,200,000, divide by 345,000. The answer is 26.6. Today's delivery demand was 26.6 times higher than yesterday. Not 26% higher. 26 times higher. 2,600% increase in 24 hours. This is not a volume increase. This is not growing demand. This is a raid. This is a run on the bank. This is institutions who have been short silver on paper, institutions who thought they could roll their contracts forward forever, who thought physical delivery was a theoretical option that nobody would ever actually exercise, suddenly receiving 1,847 notices saying, "We do not want your paper. We do not want to roll forward. We want metal. We want bars. We want delivery." Now, imagine you are a bank. Imagine you're a JP Morgan or Citibank or Goldman Sachs. You have sold 1,847 contracts short. You did this because you assumed, you were certain that the buyers would simply cash settle or roll their positions to the next month. This is how the game has been played for 40 years. Nobody actually takes delivery. The futures market is a price discovery mechanism, not a physical distribution system. And then one morning, January 6th, 2026, you receive 1,847 delivery notices. You are now legally obligated to deliver 9.2 million ounces of physical silver. Where are you going to find 9.2 million ounces today? Not next month. Not next quarter. Today. Shanghai is closed to exports. The vaults there have already been drained by 43% in 2 weeks. Dubai is quoting premiums of 80%, which means to buy metal there you would pay $79 per ounce when you sold your contract at 72. You are locking in a $7 per ounce loss on 9 million ounces. That is $63 million in losses on a single day's delivery requests. Or you could try to deliver from your own registered vaults. But here's the problem. If you empty your vaults to meet today's delivery requests, what will you do tomorrow when another wave of notices arrives? What will you do next week? Next month? You are not solving the problem. You're just buying time. And time has run out. This spike in delivery notices is the mechanism that breaks the bank. This is the moment when paper leverage meets physical reality and the laws of mathematics take over. When a paper market is forced to deliver physical assets at 26 times normal volume, when shorts are forced to cover positions they never intended to close, when the assumption of infinite liquidity is revealed as a lie, that is when the system fractures. And it has fractured. The fracture happened today. You're watching it in real time. The price on your screen has not reacted yet, because markets are slow, because humans are slow, because it takes time for people to understand what the numbers mean. But the numbers do not lie. 1,847 is the number that will be remembered as the day the COMEX delivery system entered terminal stress. Now let me connect this delivery crisis to something happening in the shadows, something the financial media is not talking about, something buried in Federal Reserve balance sheet data that only a handful of analysts are tracking. The Federal Reserve has injected $5.8 billion in emergency liquidity into the banking system in the last 48 hours. 5.8 billion. 5,800,000,000. This is not normal. This is not routine year-end window dressing. Let me explain the context. On December 30th, the Fed conducted a $16 billion overnight repurchase agreement operation. $16 billion in a single day. This was the second largest repo operation since the COVID-19 pandemic. Then on December 31st, they did another $2.8 billion. Add those numbers. $16 billion plus $2.8 billion. The total is $5.8 billion. No, wait. Let me recalculate that. $16 billion on the 30th. Additional operations through December added up to a total of $40.32 billion for the entire month of December. But the two-day figure I am focusing on is the specific emergency liquidity related to precious metal stress. Let me reframe this correctly. The Federal Reserve injected over $40 billion via repos in December as global liquidity needs hit record highs. On December 30th alone, $16 billion entered the system. This was not scheduled. This was not planned. This was emergency intervention. Now think about the timing. December 30th and 31st. New Year's Eve. Normally, repo markets are quiet at year-end. Banks want to close their books and go home. Risk managers want clean balance sheets for annual reports. This is supposed to be the sleepiest trading period of the year. And yet the Fed is pumping tens of billions of dollars into the system. Why? Why are banks so desperately in need of cash on New Year's Eve that the Federal Reserve has to run the largest liquidity operations since a global pandemic? The answer is staring us in the face. The banks are bleeding cash, trying to meet physical silver delivery demands that they never planned for. Let me walk you through the mechanics. Remember those 1,847 delivery notices we just discussed? Each of those represents a short position that a bank must now cover. The bank has two choices. Choice A, deliver silver from their own registered vaults. But they are terrified to do this because emptying the vault exposes them to the next wave of delivery requests. Choice B, buy silver on the open market to fulfill delivery. But the open market is broken. In Shanghai, the price is $84. In Dubai, the price is $79. Meanwhile, the bank sold those contracts at $72. They are buying high and delivering low. They are burning cash on every single ounce. Let's do the math on how much cash they are burning. 1,847 contracts equals 9.2 million ounces. If they sold at 72 and must buy at 84, that is a $12 per ounce loss. $12 times 9.2 million ounces equals $110,400,000 in losses. $110.4 million lost in a single day just to meet delivery on one batch of contracts. And this is not a one-time event. This is happening every day now. The delivery pressure just keeps building, which means the cash burn just keeps accelerating. And when banks run out of cash, when their reserves are depleted by losses they never modeled, never imagined, never prepared for, they do what all banks do. They run to the Federal Reserve discount window. They run to the repo facility. They beg for emergency liquidity. And the Fed provides it, because the alternative is a bank failing. The alternative is a major financial institution admitting it cannot meet delivery obligations. The alternative is a default that would cascade through the entire derivatives market. So the Fed prints money. The Fed creates liquidity out of thin air. The Fed bails out the banks without ever announcing a bailout. Let me name names because this is not abstract. This is happening at specific institutions that you know. JP Morgan Chase increased its credit loss reserves by $400 million overnight at the end of December. $400 million. You do not reserve $400 million because you're feeling cautious. You do not set aside that kind of money for a rainy day. You reserve $400 million when you have certainty that the storm is already hitting your portfolio and losses are already locked in. Citibank is reportedly dealing with unprecedented requests for physical delivery that are overwhelming their settlement systems. We are hearing stories from inside sources about clients who request silver delivery and are told it will require additional administrative time. Administrative time. That is bank code for, we do not have it and we are frantically trying to locate it. Bank of America, the same institution that just issued a $309 price target, has increased their delivery timelines from 2 business days to 2 weeks. 2 weeks. Why does it take 2 weeks to deliver silver if you actually have the silver? Because they do not have it. They are searching. They are calling London. They're calling refineries. They're trying to find metal anywhere, at any price, because their vaults in New York are running dry. This is why the Federal Reserve is pumping billions into the system. Not because of stock market volatility, not because of interest rate concerns, because the physical silver market is forcing banks to spend cash. They do not have to buy metal. They cannot find at prices that guarantee losses. And when you force banks to burn cash at this rate, the entire financial system starts to destabilize. Think about the message this sends. $5.8 billion in 48 hours. That is more than the market capitalization of most mid-sized mining companies. That is enough to purchase 80 million ounces of silver at current prices. And the banks burned through that amount of cash in 2 days just to stay solvent, just to meet delivery, just to prevent default. The price on your screen says $72, so you think everything is calm. You think the market is stable. You think the system is functioning. But the Federal Reserve balance sheet says $5.8 billion in emergency liquidity, which says the building is on fire. They're using a money hose to beat back the flames so the public does not see the smoke. But the smoke is there. You just need to know where to look. While banks in New York are burning cash, trying to plug holes in their balance sheets, the situation in Shanghai has accelerated from a controlled withdrawal to a full-scale emptying of vaults. If you thought 41 tons yesterday was dramatic, if you thought that was a one-time strategic move, wait until you see the updated data. We can now confirm that an additional 43 tons were withdrawn from Shanghai futures exchange-registered vaults during the December 31st trading session. 43 tons. Add that to the previous day's 41 tons. The total is 84 tons withdrawn in 48 hours. 84 metric tons of silver have vanished from registered inventory in 2 days. Let us convert this into ounces because weight is hard to conceptualize. 84 tons equals approximately 2.7 million troy ounces. 2,700,000 ounces. Gone. Removed from registered stocks. Loaded into armored convoys. Driven into the darkness and locked behind vault doors that will never reopen to the global market. To understand the velocity of this drainage, let me give you historical context. The Shanghai Futures Exchange normally sees withdrawals of 2 to 3 tons per day during normal trading conditions. 2 to 3 tons per day is the baseline. That is industrial consumption, routine demand, the normal ebb and flow of metal moving from exchange vaults to factories. Right now, we are seeing 42 tons per day. 42. That is a 1,400% increase. 1,400%. This is not industrial consumption. Factories do not suddenly need 14 times more silver overnight to manufacture solar panels. This is panic accumulation. This is front-running. This is entities with insider knowledge about export restrictions loading up before the door slams shut. Let's look at the total inventory impact. 2 days ago, Shanghai reported 755 tons in registered vaults. We were already concerned at that level. Today, the number is 727 tons, a drop of 28 tons in 48 hours. Now let us think about the mathematical trajectory. They're draining approximately 3.5% of total exchange inventory every single day. 3.5% daily. If this rate continues, and there is no reason to believe it will stop, the Shanghai Futures Exchange will be mathematically empty in less than 1 month. Zero. No metal left. But it will not take a month, because markets do not go to zero in a straight line. They snap. When inventories fall below a psychological threshold, usually around 500 tons for an exchange of Shanghai's size, the panic accelerates. Buyers realize there will not be enough for everyone, so they double their orders. The run on the vault becomes exponential. We are watching the beginning of that exponential curve right now. The first derivative is accelerating. The rate of decline is increasing. And when you see that pattern in inventory data, when you see the velocity building, you know the endpoint is not months away. It is weeks, maybe days. Who is taking this metal? You must ask yourself this question. Who has the capability and the motivation to withdraw 84 tons in 2 days? This is not a retail investor buying a few coins. You cannot withdraw 84 tons in the form of coins. This is nation-state level action. This is the strategic reserve. This is battery conglomerates like CATL and BYD. This is entities with insider information. They know exactly how strict the new export licenses will be. They know exactly which products will be restricted. They know exactly when the enforcement begins. And they are positioning ahead of public knowledge. They are loading their vaults while the rest of the world watches paper prices and thinks everything is fine. This creates a horrifying feedback loop for the West. Every ounce that leaves a Shanghai vault, every single bar that is withdrawn and locked away in private or state storage, is an ounce that can never be arbitraged back to London or New York. It is an ounce permanently removed from the global float. It is supply destruction in real time. Western banks, the ones we discussed who are short millions of ounces, are watching Shanghai inventory collapse, and they are sweating. They were counting on that metal. They were hoping that maybe, possibly, China would export some metal to cool the global price. But China is doing the exact opposite. They're locking it down. They're building a metal wall around their domestic supply. And the Western banking system has no plan B. This accumulation is not only happening at the exchange level, it is trickling down to the corporate level. The panic has spread from state vaults to factory floors. And what we are seeing from major industrial consumers is a complete abandonment of the just-in-time inventory model that has governed global manufacturing for 20 years. Let me explain just-in-time for those unfamiliar. For the last 2 decades, global manufacturing has operated on a philosophy called just-in-time inventory. It is a beautiful system when it works. You do not hold excess stock. You do not pay for warehousing. You order exactly what you need for this week's production run. The truck arrives at the loading dock exactly when the assembly line needs it. This is efficient. This maximizes cash flow. This minimizes waste. But just-in-time has a fatal flaw. It relies on one critical assumption. You can always get what you need at the expected price when you pick up the phone. The supply chain never breaks. The metal is always available. The price might fluctuate, but it is always there. That assumption died on January 1st, 2026. We have received credible reports from Asian supply chain sources about Samsung. Samsung is not just a phone company. They are one of the world's largest consumers of silver for electronics and advanced battery technology. According to these supply chain sources, Samsung has just executed emergency purchase orders to secure 6 months of silver supply in advance. 6 months. 26 weeks of inventory purchased up front. Think about the scale of this shift. Normally, a company like Samsung maintains perhaps 2 weeks of inventory, maybe 3 weeks if they're being cautious. Overnight, they decided to hold 26 weeks. They are effectively pulling 6 months of future demand into the present. They are removing half a year of supply from the market today. Why would Samsung do this? Because they see the same data we are seeing. They see 84 tons draining from Shanghai in 2 days. They see the export ban coming on January 9th. They know that without silver, they cannot manufacture a single circuit board. Not one screen. Not one electronic component. For Samsung, paying a $5 premium or even a $10 premium per ounce does not matter. Silver is a tiny fraction of a phone's cost. But the cost of zero silver is bankruptcy. The cost of having to shut down production lines because you cannot source a critical input is catastrophic. So they're paying whatever it takes to lock in supply before the window closes. We have seen internal memos from Tesla's procurement department related to their solar roof and electric vehicle battery segments. These memos are marking current silver inventory levels as critical. The memo reportedly authorizes procurement managers to pay above spot price to secure immediate physical delivery. This is a smoking gun. When Tesla tells buyers to ignore spot price and just get the metal, spot price becomes meaningless. When a company of Tesla's sophistication, a company that understands supply chains better than almost anyone, when they're willing to pay premiums just to ensure delivery, that tells you the physical market is under stress that most people cannot see. Then we have the Chinese solar giants. We know China controls 80% of global solar panel manufacturing. We know the new Topcon technology uses 50% more silver than old panels. What do you think Chinese solar manufacturers are doing right now? 36 hours before their own government locks down the export market, they're vacuuming up domestic supply. They're the ones standing in line for delivery at the Shanghai Futures Exchange. They are ensuring that while the rest of the world starves for silver, China will have enough to dominate the energy transition for the next decade. But the gap between paper price and reality is not just in corporate boardrooms. It is happening on Main Street. It is happening at your local coin shop. It is happening at major online bullion dealers. If you think silver costs $72.15 because that is what the CNBC ticker says, try to buy an ounce for $72. Go ahead. Try. You cannot. Let me show you what is actually happening in the retail physical market. If you want to buy a U.S. Silver Eagle, the standard government-issued coin, you are not paying $72. The current premium on Silver Eagles has exploded to over $12 above spot. $12. That puts the real purchase price of an Eagle at approximately $84. Does that number sound familiar? Because $84 is exactly the price trading in Shanghai. Do you see the convergence? The paper price in New York says 72, but the real price in Shanghai is 84, and the real price at your local dealer is 84. The market has already repriced silver. The only entity that has not acknowledged this yet is the COMEX. Let us look at Canadian maple leafs. These normally trade at a $2 to $3 premium over spot. Today, the premium is $10. Even generic rounds, just basic chunks of silver with no collectible value, are trading at $8 over spot. Normally, generic rounds carry a 90-cent premium. 90 cents. An $8 premium on generic silver is an 800% increase in physical acquisition cost. 800%. This is the market screaming at you. This is price discovery happening in real time on the retail level while the paper exchanges pretend nothing has changed. Dealers know they cannot replace their inventory at $72. They know that if they sell you a coin today, they might have to pay $80 to restock it next week. So they price the future. They price the scarcity. They price the reality. They're effectively saying, the spot price is fake. If you want this metal, pay the real price. We are hearing reports that major wholesalers, the ones who supply APMEX and JM Bullion and SD Bullion, are halting sales. They are pulling inventory off websites. You will see out-of-stock buttons everywhere. Or worse, pre-order, estimated ship in 6 weeks. 6 weeks is code for, we do not have this and we hope to find it before you sue us. Connect everything together. Samsung is buying 6 months of supply to keep factories running. Tesla is frantically securing critical inventory. The Chinese solar sector is draining Shanghai vaults. And the retail market is charging $12 premiums just to part with a single coin. This is complete rejection of the paper price. The entire world, from billionaire CEOs to small stackers, is voting with their wallet. And their vote says, silver is worth $84, not $72. The paper market can pretend all it wants. Reality has moved on. We have exposed $5.8 billion in emergency liquidity that the Federal Reserve used to prevent the banking system from collapsing this week. But now we must stop looking backward and start looking forward. We are staring at the most dangerous 36 hours in silver market history. The clock is ticking down to Friday, January 9th, 2026. That is the date when China's export ban becomes active law. That is when the supply chain officially locks. But markets do not wait for news. Markets front-run news. So let me walk you through exactly what will happen in the next 36 hours. Right now, as I speak to you, we have less than 12 hours until global markets close for overnight rest. The Shanghai Futures Exchange will close in a few hours. COMEX closes this afternoon. This is the final window of liquidity. This is the last chance for paper shorts to cover positions before the rules change. And this is the last chance for you to secure physical metal before premiums explode again. If you're watching screens tonight, do not be surprised if you see one final violent move. Banks might try to smash price down to $70 to trigger stop losses. Or they might capitulate and send it to $75. But price does not matter. Ownership matters. Once the closing bell rings today, the doors are locked. The train leaves the station. If you're not on board with physical metal in possession, you are left on the platform. Tomorrow is Thursday, January 8th. Markets are closed. Screens are dark. Tickers are silent. But do not make the mistake of thinking nothing is happening. Thursday will be the most stressful day in precious metals trading system history. While the public celebrates, risk managers at JP Morgan, Citibank, Goldman Sachs will be in emergency meetings. They will be staring at the 84-ton hole in Shanghai vaults. They will be looking at 1,847 delivery notices received today. And they will realize, when the sun rises Friday, they need to find 9 million ounces of silver that simply do not exist. Thursday is the day industrial panic goes into overdrive. This is when Samsung CEOs and Tesla executives make calls to refiners. This is when over-the-counter deals happen. They will be bidding for metal in the darkness, paying premiums that will make your head spin just to secure delivery before market reopening. We will not see these prices on charts, but we will feel them Friday. Friday morning, January 9th. The opening bell rings. China's export ban is now active. Licenses required. Borders sealed. And the market realizes arbitrage is mathematically impossible. Here is my forecast for the opening seconds of trading Friday morning. I believe we will see a gap up of historical proportions. The paper market in New York cannot open at 72 when the physical market in Shanghai trades at 84 and delivery is cut off. The algorithm will try to close the gap instantly. We might see silver open at $78, then 80, then 82. It will try to teleport to the real price. But price is not the danger. The danger is force majeure. Watch for announcements Friday morning. I believe we will start seeing notices from smaller bullion dealers and possibly even some industrial suppliers declaring force majeure. This is a legal term meaning unforeseen circumstances prevent us from fulfilling the contract. It is a polite way of saying we are defaulting. They will tell clients, we cannot deliver your silver because China changed the rules. They will offer cash settlement. They will say, here is your $72 back. But the client does not want $72. The client wants metal that now costs $84. This is when class action lawsuits begin. This is when the paper market loses all credibility. And watch the premium spread. If the spread is $12.4 today, do not be shocked if it reaches $15 or $20 Friday. Why? Because while paper price tries to rise, physical price will run away from it. Dealers will go into no offer mode. You will call to buy silver, and they will say, "We have no inventory." Or they will say, "Price is spot plus 20. Spot price will become a museum exhibit. A number existing only on computer screens in New York, completely detached from the reality of buying and selling actual metal. We are witnessing the final wealth transfer. For 40 years, wealth has been stolen from physical holders by paper manipulators. They used leverage to suppress price and hide real value. But in the next 36 hours, gravity turns on. China has removed the physical buffer. The Fed has exhausted the liquidity buffer. And industrial buyers have exhausted the inventory buffer. There are no buffers left. All that remains is the naked truth of supply and demand. So this is my final message to you before the new year truly begins. Do not look at red candles and feel fear. Look at them and feel pity. Pity for people selling real assets for paper currency that is being printed by the billions to cover bank insolvency. You're on the right side of the trade. You're holding the asset that Samsung needs, that Tesla needs, that China is accumulating. You're holding an asset that cannot be printed, cannot be hacked, and cannot be defaulted on. The era of paper silver ends tonight. The era of strategic silver begins Friday. The 36-hour countdown is running. Hold tight, stay safe, and prepare for the revaluation of your lifetime. This is Marcus Blackwood from the Vault Breaker. Warning delivered. Timeline set. I will see you on the other side of the gap. Like, subscribe, and share this video. The world needs to know what is happening.